Okay. Hey everyone, it's Rachel here with not your midday update, your Tech Talk Tuesday.
Ah,
Hey everyone, it's Rachel with your Tech Talk Tuesday from MarketEdge.com. Here with me today is David Blake. David, how are you doing?
I'm doing well, thank you.
Great. Let's get into it.
All right, let's talk a little bit about last week. We had another volatile week, and part of that was due to the FOMC meeting that came across on Wednesday, where the Fed raised interest rates another quarter point, despite the previous week's banking crisis. But anyway, we started out last Monday. We had actually Monday and Tuesday both. Equities surged pretty sharply higher. Fears of the banking crisis kind of eased. We had, the Secretary of Treasury Yellen and the Federal Reserve got together, and they pretty much kind of stopped things, nipped it in the bud, and they kind of let stop things before they got out of control, which was very good for the market. Sometimes actually this may have been a little bit of a gift to the market, because sometimes if this had gone on much longer, perhaps it might have gotten worse. We might have seen people get a little bit more scared as more banks started to notice that their reserves weren't able to be insured or backed up or anything like that. So that was good. Anyway, once Powell raised rates a quarter point, he had to do that. A lot of people were hoping he wasn't going to do anything, but that was kind of they had to kind of save face and act like they kind of knew that this was going on and it wasn't their fault. And that's why I think he did it. If he'd have come in and just not done anything, it might have caused a few more questions than answers. So initially, what normally happens, we get a move up, then a move down, then another move up, and then later on, it did sell off late into the afternoon. And I think Thursday we were also we moved down pretty low. The surprising thing was we did see rates move lower. I think on Friday, the 10-year slipped down to 338, and the 2-year had landed down at 377. That was down from 5.07 or 5.08 early in the month. I think I read somewhere where that was the biggest move over a few-week period since November of 1987, and we know what was going on back then. So, investors were pretty shook up. The bond market was actually saying that we're probably going to see some rate cuts towards the tail end of the year. I don't know. Right now, it seems to be like a flip of a coin. A lot of that will depend on economic data that we see. As far as what moved last week, of course, we saw the banking shares struggle. We saw a little bit of a rotation into the big cap technology and FANG stocks. That boosted the communication services, XLC and technology sectors, XLK. And then we also saw a little bit of a pickup in energy, XLE, and materials, XLB. Part of that was the fact that as rates come down, some traders are going to think that okay, well, maybe that'll prevent the economy from maybe going into a recession. Maybe we'll talk a little bit about that later on. But as far as what was the worst performing sectors, that was REITs and utilities. They were actually the only two that ended up closing in the red. A little bit surprising, but those are the defensive sectors, and people got a little bit more aggressive last week as they stepped in to buy the dip. As far as the technical condition of the market, it remains mixed at the end of last week. The major averages they had marginal gains. I think the Dow Jones was up 1.2%. S&P added 1.4. NASDAQ was up 1.7. Small cap Russell was only up 9 points, so I was up less than half a percentage point. So nothing big. However, it was a second straight week of gains for the S&P 500 and NASDAQ, and the Dow Jones was able to snap a 2-week losing streak. As far as the technical condition of the market, I mentioned it still remains mixed. We did see that late bounce on Friday, which kept the major averages positive for the week. They had earlier by Thursday and I think Friday morning most of them had slipped in the negative ground. I think the NASDAQ was still positive, but we did see the Dow Jones Transportation Index slip lower for a third consecutive week, and so we had some mixed signals in the secondary indexes. I talk about that in the letter a lot. Technicians like to see the transports, the small cap Russell, and even the Philadelphia Semiconductor Index kind of lead the market higher and lower. And when you have one going up, one going down, you just have the mixed signals. On the plus side, we did see the Philadelphia Semiconductor Index up for a second straight week. But the last 2 days, yesterday, Monday, and today, we're seeing a pullback in that, which is a little bit troublesome. So we can't get the momentum going. We did see the S&P 500 was able to close above its 100 and 200-day moving average on Friday, and it also has so far been able to stay above its December low, which is a positive for the market going forward. The Dow Jones still remains below its 200-day moving average. It can't seem to get through that resistance level, which we need to see here pretty soon. The NASDAQ has been outperforming. Again, that's on the strength of the technology stocks. It's trading above all its key moving average levels, which is again positive. It's actually better once you see the Fed pause, and this was done by Blackstone several years ago. Once they get to the point where they pause, Blackstone did a study where actually the technology sector outperforms the rest of the market. And over the last 2 or 3 times where we had where they paused on a rate tightening, the average return for the technology stocks were up about 15%, going out about 6 to 8 months. So that's kind of where you want to be looking at this point, maybe buying some of the dips. Again, we did have some positive divergence going on with the semiconductor index. It actually hit a year-to-date high on Thursday. So despite yesterday and today's pullback, I still think once the economy starts to firm up a little bit as rates come down, semiconductors again will be a place where we want to go. Now, underlying breadth was mixed. The week before was it was a little bit better, but this week was NYSE and NASDAQ advanced decline lines which we consider kind of leading indicators of market direction. They posted small gains, and by small gains I mean maybe 900 units, something like that. 776 units for the NYSE, and I think the NASDAQ it advanced like 600 units. So we're not seeing the bulls or the bears take charge here on this over this last week. And then today, like yesterday was mixed. We were mixed earlier this morning, but now we're seeing the major averages pull back a little bit again. New 52-week lows continue to outnumber the new highs, although yesterday for the first time, I think on the NYSE, we had 34 new highs, 34 new lows. So again, that just shows you that they're not, neither the bulls or the bears are committed to this little bit of a bounce that we've had here. As far as investor sentiment goes, the retail they're still a little bit they're still very bearish. In other words, we had a slight tick higher in the bulls, only like 1.5%, but that's coming off of the lowest percentage since last September. So I wouldn't read much into that. And then we also saw a little bit better participation in the pros. The National Association of Active Investment Managers Exposure Index increased to 53.2. Again, that's not much of a commitment. You're just barely positive on your exposure, but that's up from 39.7% or 43% the week before. And then you had the percentage of bullish investment advisors. It actually ticked lower to a bearish 39.7. So even though you have some analysts coming out here and they're saying, okay, well, the bottom is in, we're ready to go here. There's a pause for the Fed. It's going to be a bit of a struggle going forward here, I think. Despite the fact that we've had some up and down here with the rates. I wrote last night that as we get our economic data this week, in the past year, it's kind of been, okay, bad news is going to be good news. That means that it just puts pressure on the Fed to maybe pause. Now it's more of a bad news is bad news. And the reason for that means that as we've already paused and we're not looking at any more rate hikes and looking at possibly a rate cut towards the end of the year if things get real bad. The reason that's not good is it means the economy is closer to falling into a recession, which will not be great for stocks. So again, it's we got a lot of headwinds still coming in here. Again, mixed signals. I did change the CTI to bullish last Friday, only because for several reasons. It wasn't a confirmed signal, but the cycles that we're looking at are really stretched. There's generally historically they reach a certain level, and some of them will go 2 weeks or two weeks further, 2 weeks past, and we are getting to the point on some of these where you were getting to 4 and 5, almost 6 weeks past where they should have bottomed out. So at this stage, I think that the bottom that we saw, the week of the ending of the 17th, it was probably it. Now we had cycle B, which is an 18-week cycle. It had gone 22 weeks, and that's just it's not something that you normally would that you like to see. In fact, that's a bearish signal for the overall market when they get stretched out that far. So we are going. The CTI looks positive now, as long as that bottom there from the week of the 17th holds. But we're only bullish for about 1, 2, 3, 4, 5, 6, 7, 8 weeks, which takes us into maybe mid-May. And I will tell you that some of those short-term cycles are also bearish. So I think that we could probably have 3, 4, maybe 5 weeks where the market looks pretty good. Where we can maybe nudge higher a little bit, but I don't see this thing all of a sudden kicking in, and we see the bulls jump in, take control, and then push this thing to take out the highs from back in February or whatever they were when we hit a high and we started to roll over again. So anyway, at this stage, again, cautiously bullish on the market, on our posture. I think you can probably nibble away on some stocks that you'd like to own for the long term. Maybe on some of the dips. If you see, there's some of these big cap tech stocks like Apple and Microsoft and Nvidia. Some of them they've had a heck of a run here over the last couple of months. Some of those are up 14, 15, 16, 18%. If you see them pull back, maybe 8 to 10%, you might want to nibble on some of those for the longer term. I wouldn't nibble on them just with a dollar pullback or something like that where you see a 1 or 2% drop in those stocks. But I think if you have like a bad day where the market's down 400 or 500 points, you could probably start to buy, add the positions, maybe a quarter of a position, something like that, going forward here until we get a little bit more economic data to see how close or if we're going to fumble into a recession here in either the summer or later on in the year.
All right, thank you for that. So the market posture, as you mentioned, has moved to bullish from neutral. With a recession possible later this year, how high do you think the S&P can go? And can you mention some of the sectors that normally perform best either going into a recession, or what would investors look to buy as the economy begins to strengthen?
Okay, that's a lot there that you're asking. What we'll do is let's do the sector, what you should buy going into a recession, and once the market gets close to bottoming again, what you want to buy going out. We'll cover that next week. I think that's something that probably our subscribers would want to know, and if we can give them something, here's a cheat sheet here to look at, so as we start to see what's going to play out in the market over the summer, they can have a little list of things that they want to buy, what sectors they want to go into. But as far as the CTI, like we just mentioned, it was a call that to go bullish. Mainly, part of the reason is because the cycles were so stretched, and we did see a pretty good bottom there on I think it was the 14th or 15th of the month. The S&P 500 did stay above the December, the December low. That was a positive. The NASDAQ, I think, has done that also. The Dow did not do that, but the Dow really didn't have much of a pullback in December. It was the one that was outperforming at that stage. Now, I will tell you this: with the yesterday and then today, the S&P 500 is kind of churning. It's got a little choppy trading, kind of churning back and forth. But we did see some positive, motion in it where we went above the 100 and 200-day moving average. I'm going to pull up a chart on my stuff here real quick. Okay, so today we're still above the 200. The S&P 500 on today's pullback, and right now it's down 16 points to 3960. It's sitting basically right on the 100-day moving average, and then we get up around 4,013. That's the 50-day moving average. If this market's going to get going, I want to. This is kind of cut and dried. As far as the technicals go, the S&P 500 needs to close up here with that 40.15 to 40.30 area. If it doesn't do that over the next, maybe this week, let's say, it's going to be bearish for the market. And at that stage, we actually could slip back maybe to a neutral market position. But I think maybe we can see it do that because the indicators have improved a little bit. But if it can do that, then I think what we'll probably see, if we gain some momentum, we should be able to see a breakout of this thing. And the pivot point on the S&P 500 is around 4,035. We should be able to see the S&P 500 make a run up close to maybe 4130 to 4150. And that I would expect to see it get up there maybe into May. And then I think we'll have to reevaluate because, as I say, the cycles again come into a bearish connotation here later on as we go into the summer. But for this thing to get to that 4130 to 4150, we need to see this week to see this thing. Number one, if we have a bad day and then it bounces, you want to see it hold the 200-day moving average. I'd like to see it hold the 100-day moving average today, which is at 3960. So if we can cross across that, we should be good for a few weeks. But if we don't get above this 4,015 area or so, it's going to be kind of another negative for the market. So I think right in here we're kind of at a tipping point where the bulls can try to make a stand. I think I said last week that we were hoping they could make a stand there at the 39.35, and they actually did. We had a nice bounce, but we're starting to pull back from that. But if we can get above here, and I still think that we possibly can, we could get a rally here into May, which should be a good trade for you. I think at that time you may want to. We'll probably start to see some weaker economic data that you may want to lighten up on some positions at that stage up around the 4150 area if we can get that high. But for the next few days, you really need to keep an eye on this 4,010 area because that's a must that the S&P 500 gets through that for this market to begin to have this April-May seasonality rally that we normally get. Other than that, I think that maybe going into summer we could still stay range bound, while we try to figure out whether or not we're going to go into recession. And as I mentioned before, we will talk about what sectors you want to start having more exposure to as the economy slows down and a recession becomes more apparent. And then if that takes too long, then the following week we can get a little bucket list of sectors and stocks that we may want to look at if we could avoid a recession, or whether we can start to get a little bit more upside momentum.
Great. Well, I think that's short and sweet for this week. Do you have anything else you'd like to add?
No, I don't. Again, just make sure you keep track of that. This week, the big deal is getting through the 4,010, 4,015 area, and that's pretty much we need to see that for this market to have some legs going forward into the next month or so.
Perfect. Well, we appreciate you being here, David, and we'll talk to you next week.
Sounds good.
If you have any questions for David or anyone at the MarketEdge team, feel free to send us an email at support@marketedge.com or shoot us a message in that chat box in the lower right-hand corner of our website. We'd love to hear from you.